Okay, so let's get right into it. We're talking about zero commission brokers. The idea that we can all trade stocks and options totally free right from our phones. But come on, we all know nothing's ever really free. So what's the actual price we're paying? Let's dig in.
Right, this is the big question, isn't it? Tapping a button to buy a stock, it feels so simple, and it costs you zip in commissions. But behind that one little tap, there's this massive, multi-billion-dollar machine that has completely changed how Wall Street works. And to really get it, we actually have to rewind the clock a bit.
It's kind of wild to think about, but before 1975, a single stock trade could set you back this much. We're talking up to $200. Trading was basically a luxury, a club for the rich. The whole idea of a regular person buying stocks? Almost unthinkable, because the fees were just way, way too high.
And now, today, the standard commission is zero. A big, fat nothing. Going from $200 to $0, though, that didn't just happen overnight. Nope, it was a revolution, and it took decades to unfold. So how on earth did we get from there to here?
Well, it all kicked off with an event they call Wall Street's May Day. And this was the moment that the old, stuffy system that kept prices crazy high finally came crashing down.
For almost 2 centuries, the New York Stock Exchange had this system. Every single broker had to charge the exact same high fixed fee. Now, this was awesome for the big Wall Street firms, but it was a pretty raw deal for individual investors. That whole system got blown up on May 1st, 1975, and that's what opened the door for competition. And this timeline just lays it all out perfectly. After that May Day event, you had deregulation in the 80s that brought in the first discount brokers. Then, boom, the internet shows up in the 90s, making trading electronic and even cheaper. Fast forward to the 2010s, and you've got fintech apps starting this all-out price war, pushing commissions under $10. And then finally, in 2019, the whole industry just went to zero, all thanks to a brand new business model.
So, okay, let's follow the money. When you place a so-called free trade, what is actually happening behind the scenes? It's definitely not as simple as you think, and it's where the real business model of your broker starts to come into focus.
The secret sauce here is a practice called payment for order flow, or PFOF for short. It's controversial, but it's totally legal. And put simply, it means your broker is basically selling your trade order to a giant wholesale firm. Let's break down exactly how that works.
So this all happens in a blink of an eye. You tap Buy, your broker, instead of sending your order to a public exchange like the NYSE, zips it over to a massive wholesaler like Citadel Securities or Virtue. That wholesaler then executes the trade for you, and in return, they pay your broker a tiny little fee. We're talking fractions of a penny per share. But when you're dealing with millions and millions of trades, believe me, those fractions add up fast.
Okay, so you might be wondering, why would a wholesaler pay for your order in the first place? Well, they make their money on something called the bid-ask spread. It's just the tiny difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. By handling millions of these trades, they capture those tiny little gaps over and over. And in exchange, they often give you what's called price improvement, which means you get a slightly better price than you would have on a public exchange. And this slide really nails the central trade-off here. When your order goes to a wholesaler, you often get a better price, and it happens faster. So what's the downside? Less transparency. The process, called internalization, means the trade happens kind of in-house, away from the public view of the stock exchange. And that's the fundamental debate here, efficiency versus transparency. But here is the real plot twist. While everyone is so focused on payment for order flow, it's not even the main way these zero-commission brokers are making their money. No, not by a long shot. Just take a look at this. A whopping 55% of their revenue comes from earning interest on the cash that you just leave sitting in your account. The broker takes that cash, invests it, and keeps most of the profit. Another 20% comes from lending money to traders to trade on margin. And PFOF, it's only about 15% of the whole pie. The free trading is just the hook. The real money is being made somewhere else entirely. But hang on, let's go back to that 15% from PFOF for just a second, because not all trades are created equal. You see, the most lucrative orders a broker can sell aren't for stocks like Apple or Tesla. Nope, they're for something much, much riskier: options. And here's exactly why. A broker might get paid, say, 13 cents for an order of 100 shares of a stock, but for a single options contract, they can get over 42 cents. That is more than 3 times as much. And this is the really crucial point. Brokers have a powerful financial incentive to get their users to trade more complex and often much riskier options.
Now, this entire system, the whole thing built on payment for order flow, it's a uniquely American thing. The rest of the world has taken a very, very different approach, and that's sparked a huge global debate.
So here in the United States, PFOF is legal. The main rules are that brokers have to disclose it, and they have to promise to get customers the best execution possible. But over in the United Kingdom, and soon across the entire European Union, it's banned, completely. Regulators over there just decided the conflict of interest is too big to ignore.
And this whole debate really came to a head here in the US not too long ago. Back in 2022, the SEC, the Securities and Exchange Commission, actually proposed a new rule that would have pretty much dismantled the PFOF model as we know it.
Yeah, the original plan was this order competition rule. It would have forced most retail orders into open auctions, letting wholesalers and exchanges compete for them on a trade-by-trade basis. But after a big leadership change at the SEC in 2025, that rule was completely scrapped. And that pivot was a huge, huge victory for the zero-commission brokers and the wholesalers, basically cementing POFF's spot at the very heart of the U.S. market for the foreseeable future.
So where is this all headed? Well, the industry is now using this business model to build the ultimate super app. One single platform to do everything. We're talking zero-commission trading for stocks, options, crypto, all of it. Supported by PFOF, and then combining it with high-yield cash accounts and lending programs to squeeze out every bit of revenue. It's the ultimate one-stop financial shop.
Which brings us all the way back to where we started. Look, zero-commission trading has, without a doubt, opened the doors of Wall Street to millions of people who were locked out before. But it's all built on this incredibly complex system of hidden revenues, from the interest on your cash to the quiet sale of your trade orders. It's not really free. The price is just a lot harder to see. So the question you really have to ask yourself is it a price you're willing to pay?